Hey, good afternoon, everyone. Chris here with LazyFA.com, back again for a weekly investment analysis contest, fundamental analysis video. If you're not familiar with how this works, just do a quick explanation of exactly what this video is and what we're doing. If you have never used LazyFA before, LazyFA is an automated web application that helps you to make better investment decisions. So it's basically for doing fundamental analysis, but doing it really, really quickly. And what we do is each week, we pick a stock that's been in play for that week, and then I'll do a quick analysis of that company using LazyFA and just sort of share my thoughts on it very briefly. And then for the next week, that stock will be free across the entire site so that anybody can jump in, use the site, use everything on it to do their own analysis for that one individual ticker. And then you'll be able to submit that analysis in either a Reddit thread or in the YouTube comments in order to get a free month of LazyFA. So that's basically what we do here, and we do it each week. And this is now the second installment. So if you missed the first one, feel free to go back and take a look at it. I think we analyzed fossil brands the last time. This week we're going to be looking at AMAG Pharmaceuticals, and this is a new company for me. I've never looked at it before. It is a biotech company. It looks like they are in the diagnostic substances industry, according to my data anyway, which could be off. But AMAG Pharmaceuticals is a biotech company. They manufacture, develop, and commercialize therapeutics for women's health, anemia management, and cancer supportive care in the United States. So it's a biotech company. And the reason that I thought that this particular company was interesting for this week is this big giant spike on the chart, and I kind of wanted to understand, what's the dealio, like what's going on with this company? Why is this big spike here, and is there anything behind it? So I'm going to actually just quickly, since I have never looked at the stock before, I'm going to actually just look at a chart and see sort of what the longer term trend is. And let's see. So it was AMAG. So, okay. So the long-term chart does not look very good. Looks like we're kind of on a bottom here. This $12 area has been long-term support for quite a long time. It looks like back in 2015, we had some sort of major event that caused a long-term downtrend, and now it looks like you're sort of coming out of this trend. So from a technical standpoint, this could potentially be a good place to buy, but obviously when we look at a stock and we see that it's gone from, what was it, $75 or $76 down to $19 over the last 2 years, we kind of want to know why. So let's start there. First thing I always do when I look at these things is just figure out what the spike on the chart is. And this looks like it occurred within the last 5 or 6 days. So it's going to be here in the news relatively recently. And it looks like it was on the 15th, either the 15th or the 14th aftermarket. It says AMAG Pharma looks FDA approves auto-injector. So let's just take a quick look at that. Shares of Antares Pharma. So that's ATRS. AMAG said the U.S. FDA has approved their McKenna subcutaneous auto-injector drug device combination product, a ready-to-administer treatment to reduce the risk of preterm birth in women who are pregnant with only one baby and who spontaneously delivered one preterm baby in the past. So it seems like there's some sort of an auto-injector, like an EpiPen deal, that is marketed to prevent premature births. So that's the very, very high level of what this spike is. Knowing that, it's not uncommon to see a stock shoot up 50, 60, 70% on FDA approval of some kind of product or one of their drugs or whatever. So that doesn't really surprise me. The question is, what is the company worth at this point? And so looking at just sort of the high level, I can immediately see that there's a humongous spike in revenue from 2008 to 2009 from 1.94 to 17 million. So from 2 million to 17 million, that's a giant spike. From 2009 to 2010, we had another massive jump in revenue, about over 300%. 17 million to 66 million, and then again in 2014. So their revenues are through the roof. Simultaneously, costs looks like it's following the same trend, assets following the same trend, and total liabilities and debt also following the same trend. So to me, that says that the company is probably just taking on debt in order to develop their product and to grow their revenues. This is most likely at least currently, this is probably an unapproved drug. I don't know anything about the company yet, but we're going to learn. So that said, net income is obviously negative for a long period of time, and then we have this big spike in 2014, and then we're back to negative at this point in 2016. And by the way, these numbers are for the annual section. These numbers are the last annual data. So 2017 data should be coming out soon whenever they release their next earnings, but the quarterly data has the most up-to-date quarterly info. I usually get this data within like a couple of days after they release their earnings. So if it's out of date right now, it may be being updated by the data provider. So, but the quarterly data gives you a little bit more insight as to, where things stand right now. So looks like we had a big drop off in net income. We had a big increase in debt in 2014, again in 2015, and then again in end of 2015. So it looks like the end of 2014, beginning of 2014, end of 2014, and then end of 2015. We had these big increases in debt, and they're kind of like a stair-step pattern. So that might mean that maybe they did a secondary offering or something along those lines. And we can actually see that if we look on any one of these charts here and just look at, let's look at like shares outstanding, like weighted average shares. Yeah, so you can see, it looks like starting in 2014, they started diluting the stock pretty significantly. We've gone from 22 or 23 million shares up to 35 million. So that's most likely the reason for these big increases in assets, liabilities, revenues. It's probably related to secondary offerings and dilution. So just keep that in mind as we look through the rest of this stuff. One of the other things that I always do when I'm initially looking at a company is I just go through this red flag analysis, which gives me sort of pointers in terms of what I want to look at and where I want to dig deeper. And it's all the way here at the bottom under the red flag analysis section. And so we can see that AMAG's got a number of different red flags that are triggered, and some of them might be concerning and other ones might not be. Average cost growth outweighs average revenue growth. Net income is negative on average, and EPS is negative on average. To me, that's probably to be expected for a biotech company that's in the process of researching and developing these drugs. So that's not super concerning for me. I would want to understand sort of what the pipeline is and when they expect to be net income positive and EPS positive. But for right now, it's not a super big concern. I just want to understand what the future holds for the company. Same thing with net margins, currently negative. And then these revenue, EPS, and debt load flags tell us whether revenue is increasing every single period over the available data range, which in this case is 19 years. So we've got 19 years of data, which is a good amount of data. And this tells us that over that entire 19-year period, revenue increased about 50% of the time and decreased the other 50% of the time. Same deal with earnings per share. The monotonicity was about 55%. So 55% of the time, earnings per share was higher than the period before. And then debt load, only 5% of the time, debt load was lower than the period before. So this flag is debt load strictly decreasing. So this basically means that 95% of the time, their debt load either increased or stayed the same. So that's something to keep in mind as well. The other one that expectedly, I think, triggered true is the excessive dilution alert. This is pretty common for biotech companies just because biotech companies don't have any way to make money other than selling stock. And so they do these secondary offerings and they push more stock into the market in order to raise capital, which then gets invested back into the development of their drugs and so on and so forth. That cycle will repeat and continue for years until the FDA finally approves the drugs and they're able to actually get them out there in the market and start making some money off of them. So this is not surprising that this triggered. Over the course of 19 years, the average share count growth rate was 10.2%. The threshold for something that's considered to be high dilution in terms of like a large company would probably be something like 3%. So 10% is not super high for a company that's not even really expected to have a low dilution rate, since it's a growth stage sort of biotech company. I've seen some biotech companies that are, up in the 70, 80, 90% dilution rate. That's where it starts to get concerning to me. So I'm taking the type of company into consideration there. And then the last one here is top to bottom line divergence alert, which basically just tells us that at some point over the course of 19 years, we've seen a divergence between the top line and the bottom line, meaning revenue versus net income. And what this is telling us is that the reason for the alert is that net income growth and revenue growth have different signs. And so we're looking at the average revenue growth over 19 years is 75%, whereas the average net income growth is negative 22%. So that is basically just telling us that revenues are going up, but net income is going down on average over 19 years. So that's something that we want to understand why that's happening and how much of that is related to research and development into their drugs and other stuff. Next, let's just take a quick look at the balance sheet in the interest of not making this video too long. Average liabilities growth outweighs average asset growth. Same deal with the average revenue growth and average cost growth. This is common for growth stage biotech companies. Doesn't really bother me. Overweight intangible assets. This one can be somewhat concerning in my opinion. This is telling us that as a percentage of total assets, AMAG is basically 70% is intangible, like a brand name or intellectual property or something that you can't easily assign a value to. And so that makes it difficult to truly value, their asset base. So I would want to understand what those assets are. Why is 70% of their asset base currently intangible? That's something that I would want to understand for sure before I made any kind of long-term investment in this. The other ones that have triggered true are outliers in the debt load growth, outliers in debt load, outliers in debt load growth, and then same thing for accounts receivable. Again, we had all those big spikes on the dashboard, and all of those, it looks like, were kind of in sequence, or not in sequence, but they sort of were in lockstep. So if we look at like accounts receivable, we're going to see, where the hell is receivables? There it is. So you see the same big spike as you see in growth and you see in revenue. Probably going to see the same thing we have debt down here actually. So you see the same thing in debt, you see the same thing in accounts receivable. So all of this stuff is interconnected somehow. What we probably want to do in order to figure out exactly what's causing that is start with the debt. And I would go to probably March of 2014. Let's actually just do this right now. And this is one of the really cool things about LazyFA is that it makes it really easy to figure out what caused a big spike in some line item on the balance sheet. So in this case, we're looking at the 2014 March 31st quarter, and we're going to see that debt from 2013 has increased to 162.56 million. So if we put in AMAG here, and then we're going to look for 10Qs, and we're going to find the one that's around 2014 March 31st, which is going to be this one. It's going to be the one that was released after that date. We'll go into the documents, get into the 10Q. Let's make this font a little bit bigger. By the way, in the future, LazyFA is going to be able to read these as well, so it'll be a much nicer interface than what you get from the SEC. There's going to be most likely a note somewhere on the balance sheet, and I'm going to try to find that real quick. Notes to condensed financial statements, statement of operations. What we really want is 162. It's actually right here, 162,561. I think that was the number. 162.56. Yeah, so that is a convertible 2.5% senior note. So this is a long-term liability. There's most likely going to be some other reference to this, sort of explaining what it is. Okay, maybe not. Convertible 2.5% senior notes. So those are them. Description of the business. Accompanying notes. Okay, so here it is. In February 2014, we issued $200 million of 2.5% convertible senior notes due February 15th, 2019. Interest is payable semi-annually, beginning on August 15th, 2014. Fair value of the notes, blah, 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 blah. Estimated fair value was $161.8 million. In addition, in connection with the pricing, we entered into convertible bond hedge transactions, or convertible bond hedges, whatever those are. Separate warrant transactions. So there was obviously some sort of debt issuance around this time period that we need to understand, the terms of that. We need to understand how much it's costing them. We need to understand when it's due. February 15th, 2019, it looks like, for that portion. But then they're also probably, it looks like they're maybe doing the same thing 6 months later, and then again 6 months after that, 6 or 9 months after that. So the debt is just something that we want to sort of understand a little bit better, I think. So I'll just leave it at that for now. Let's move on to the cash flow statement. And by the way, these charts, if you hover over these charts, it'll explain sort of what to pay attention to in them. So they're connected with these tables up here. There's a lot of information on this that I'm not going over. I just like to quickly glance through the red flag analysis just to give everybody sort of a quick understanding of what is going on. So outliers in operating cash flow growth. These items here, right, like operating cash flow growth, free cash flow growth, they typically trigger in pairs. Like if there's outliers in one item, then there's going to be outliers in the growth rate of that item. So don't let that deter you just because it looks like there's a lot of red flags. It's just there's several different items that they have triggered on. So keep that in mind. And then it looks like there's also some outliers in capital expenditures. And it will show us 2008 was a significant investment in capital expenditures. It looks like 20.4 times the normal deviation from the median. So that's a big jump. Same thing here, actually. This one didn't trigger because the threshold is 15 times. But in 2016, there was a large capital expenditure as well, it looks like. So we want to look into what that was. Free cash flow, 2009, 2015, and 2016. This is most likely related to those Not sure about 2009, but 2015 and 16 are almost certainly related to those debt issuances. And then operating cash flow, I'm going to guess, is the same periods. Yeah, 2009, 2015, and 2016. So everything seems to be tied back to those debt issuances that we want to understand what's going on there. The last section I'm going to look at here is the cross-statement analysis, and what this does is compare items from different financial statements to each other. So we can look at things like an item on the balance sheet compared with an item on the income statement, or an item on the cash flow statement compared with an item on the income statement, or whatever. So I've got a few standardized ones that we look at, like the accounts receivable to sales ratio, accounts payable to sales ratio, operating cash flow to earnings, and then outliers in PPE to total assets. So there's a few different ones here that have triggered. It looks like accounts receivable to sales. This will trigger if total accounts receivable makes up more than 30% of total sales for any period within the available data range. And it looks like 2014, again, most likely tied to that debt issuance. Maybe they took that debt and I'm not sure what they did there, but we'd have to look at that. And then same thing in 2009. And again, accounts payable, 5, 6, 7, 8, and 9. So their accounts payable to sales is, at least not recently, but we probably want to look at this just because this is consistently high. So there's 5 violations of that 30% threshold. So something we just want to look at, it looks like they have a history of running a high AP to sales ratio. So we probably want to pay attention to that and make sure that it doesn't get out of hand in the most recent data. Now, it hasn't triggered since 2009, but that doesn't mean that it couldn't trigger again in the future. All right, so very, very quick analysis. Obviously, we only took about 15 minutes or 20 minutes here. There's a lot more stuff that we could look at. Revenues in terms of manipulation. We could look at a couple of different fraud detection models, the Beneish M-score and Benford's law. We could look at potential expense manipulation. Typically, you won't see any kind of manipulation like this if the numbers look bad. I mean, at least in my experience, there's no, like with a company like this, the numbers kind of look bad anyway, and that's just to be expected. So to me, there's just no real benefit to the management to manipulate. But the Beneish M-score will look for items that would potentially give management an incentive to manipulate. Like it looks at employee incentive plans. It looks at gross margins. So there's a bunch of different stuff that the Beneish M-score looks at. As of 2017-9/30, it is unlikely to be a manipulator. I see very few that this actually triggers on, and the ones that it does trigger on, they're pretty obviously fudging the numbers. So each one of these items has an explanation of exactly what it is, what it's used for. You can feel free to dive into those as well. I would certainly recommend it. This stuff is not finished yet. It's coming hopefully in the very near future. I've got the ownership forms. We've looked at Form 4s already, which I think is going to be very cool. I've actually got another video that I just put out a couple of days ago that explains how I'm using LazyFA to analyze insider trading activity by looking at Form 3, 4, and 5 and 13F filings. So feel free to take a look at that. But let's leave it at that for right now. Once again, just take a look at the description. All of the rules for the contest and everything are in there. But basically what I'm looking for is just your participation in terms of the amount of analysis that you do. I'm looking to spur discussion on these companies because with a lot of people looking at them, we can learn a lot more, and we have a lot more eyes on the numbers, and we sometimes find some interesting anomalies or interesting investments that we wouldn't have normally found. So let's leave it at that for now. Thanks once again for checking this video out. If you want to sign up and analyze this stock, it's going to be free all week. All you got to do is go to LazyFA.com, throw in your email address, make up a password, and there you go. So with that, thanks very much, and I'll see you all next week. Peace.